Have you ever wondered how economists measure the true health of a nation's economy, tracking all the wealth generated and all the income earned? It might seem like a simple task, but getting a complete picture requires careful accounting, moving beyond just one number. To convert national income to gross domestic product, or GDP, you primarily need to make three adjustments. Add indirect business taxes, subtract subsidies, and add consumption of fixed capital, also known as depreciation. You also need to account for net factor income from abroad. These adjustments are necessary because national income measures the total income earned by a country's residents, whether that income comes from production domestically or from abroad. Gross domestic product, however, focuses strictly on the total market value of all final goods and services produced within a country's geographical borders during a specific period. One measures income to residents, and the other measures production within the borders, so reconciliation is key. The first major adjustment addresses the difference between factor cost and market price. National income is calculated at factor cost, meaning it reflects the cost of resources like labor and capital. GDP, on the other hand, is measured at market prices, which include indirect business taxes and exclude government subsidies. Therefore, you add indirect taxes and subtract subsidies to move from factor cost to market price. Next, we tackle the consumption of fixed capital, commonly known as depreciation. This represents the wear and tear on capital goods used in production. National income is a net measure, meaning depreciation has already been subtracted. Since GDP is a gross measure, encompassing all production regardless of capital wear, you must add back this depreciation amount to national income. Finally, consider the net factor income from abroad, or NFIA. This figure represents the income earned by a country's residents from their investments and work abroad, minus the income earned by foreign residents within the domestic economy. National income includes this NFIA because it is income earned by residents. However, GDP only counts what is produced within the domestic borders, so you must subtract net factor income from abroad from national income. So, the formula is GDP equals national income plus indirect business taxes minus subsidies plus consumption of fixed capital minus net factor income from abroad. Understanding these precise adjustments is crucial for accurately comparing economic performance across countries and over time, giving policymakers and analysts a consistent basis for evaluation. By meticulously converting national income to GDP, we gain a clear, internationally comparable measure of a nation's total economic output. This ensures that when we discuss economic growth or compare economies, we are all working with the same comprehensive data set, enabling more informed decision-making and deeper economic insights.